It's not been the greatest day in the market, with many stocks deep down into the red, and we've also noticed investor sentiment is still sitting in the neutral region, although just last week we were sitting in fear. A few weeks ago, in fact, we were deeper into that region, and one thing we continually talk about on this channel are companies trading at severe valuations, well above their own 5-year average. We also noticed that in JPM's latest report, they only see around 9% upside to the overall stock market, at least for this year, and they also have some doubts about how strong this market is, with estimations of the second half of 2025 showing a recession by 30% and all of next year sitting around the 45% mark. So today's episode is very important. We want to take a look at 4 stocks that look very cheap, not only upside more than the 9% of the wider market, but also ones, and each one has shown institutions very bullish. They have been buying, and we are going to incorporate that into our own analysis. Now, the first one is Alphabet. This is a company that has outperformed the S&P over the last year, up 31%. Over the last 10 years, massive outperformance, up 582, and whilst it does trade at the upper end of the 52-week range, we can see such an incredibly cheap valuation, around a 20 forward P, and that is not only lower than the average of the S&P right now, around the 25-26 mark, but also the lowest in the Mag 7, with both Wall Street and Seeking Alpha considering this a buy. Also note, 4.41 isn't far off Wall Street's 4.5. That would turn this into a strong buy for the company, and they also pay a yield of around 0.44%. We also like the fact that this is a company that is green right across the board. What we mean by that is over the last 4 quarters, they have outperformed every single earnings, 100% track record, and over the next 4, they do anticipate each one of them, all in 2025, to show growth to the earnings per share on a year-on-year comparative. If we also look to this full year with their earnings per share of $9 estimated, the forward P, as we've just mentioned, does sit at 20.5, and what we always like to do on this channel is compare it to the sector median. Now, we do notice it is a lot lower, of around 14, but bear in mind, even though this company trades at a 42% premium, we do believe it is worth it, something we can touch upon briefly, but more importantly, when compared to their own 5-year average of 25.4, Google is trading 20% lower, and this is something we typically talk on this channel about being one undervaluation signal. Now, we're going to run through a few different valuations for the company, our own one at the end as well, so bear in mind we're not looking at any of these in isolation, but the model we have here is based on the 5-year average forward P, the blue tunnel being the expected price. First thing to note, nice to see it has been moving forwards, moving upwards, which is something we want to see. Companies we want to invest in are those that tend to improve year on year and are worth more. What this means then, right now, sitting at the lower end of the blue tunnel, this is what we would call an undervaluation signal, and something just to reinforce that is when we do compare it to its own forward P. As we've mentioned, for Alphabet, it does sit lower, again, another undervaluation signal. Now, we did talk about this company being worth a bit of a premium, and what we mean by this is year on year, their revenue is up 14%, the sector low single digit at 1.9, that is a good sign, although we have to point out their 5-year average does sit higher at 18%. Forward looking, expecting 12%, again, a lot higher than the sector comparative at 1.9, hence a premium does look like it is worth it for this company, although again, we should note it is lower than their 5-year of 15.5, and in terms of their earnings per share, Alphabet is expected to grow over the next 3 to 5 years, 16.6% above the sector at 12, and only marginally lower than their own 5-year of 17.9. In terms of the profitability, they get an A+. Another reason for its premium, gross margin 58%, higher than the sector at 52, also higher than their historical data of 56. Bottom line, 29%, significantly higher than the sector at 3.8, also higher than their own 5-year of 24.2. But also, this is one of those in the Mag 7, not only the cheapest valued, but one of those that actually generates the most cash from operations, 125 billion, significantly higher than the sector of 325 million, but also significantly higher than their own 5-year metric of 86 billion. Now, before we jump into our own valuation, as we mentioned, each one of these companies, institutions themselves are loading up. They hold around 40% of Alphabet with around 50 billion worth of sales over the last year, which is pretty much all of 2024, but they have been buying a lot more, 85 billion to be exact, and not only that, in the most recent quarter of Q4 2024, institutions bought more than double than what they sold. Now that is a very good sign, but as always, we never buy or sell based on the institutions. We always like to do our own due diligence, and this is our valuation process that we were talking about. For Alphabet, we get to $226 derived from the DCF model. Now we don't stop there, as we do want to explain to you how we arrived at the price, and as you can see, free cash flow year on year, average growth 20%, we've gone 12%, a lot more conservative than even analyst targets, and with the discount rate, we get the present value of future free cash flows and terminal value, we add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as you can see, 226 indicating 22% upside. Now bear in mind, these numbers, low, medium, high, are subjective, and you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it is for Alphabet or any others. But full transparency, at the 10% point, $197, still upside, although limited to 6%, and for those that are a lot more bullish, at the 14%, $260, indicating 40%. Now, as we always do, we take through the medium rate, 12% today, where we're still not done, as we like to apply a margin of safety. 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that today, a buy at $203, then we keep going till it's near the current trading price, and around the $181 mark, you're getting a 20% MOS. But for today's episode, given the company is trading around 185, you're sitting between 15 to 20%, although more towards the 20% region, with Wall Street themselves seeing this as a buy. As we said earlier, near a strong buy rating for them. They see this at $222 over the next year, indicating 20% upside. So near 20% MOS, 20% upside. For you, is this a buy, hold, or sell? As always, do give us your thoughts below. The next cheap stock we have is Micron Technology. Now this is up 28% over the last year, now trading in the mid to lower end of the 52-week range. For long-term viewers, you know we talk about this company quite a lot. In fact, it is one we were saying looked incredibly like a great opportunity at the 52-week low around the $80 mark. At this price, we still do believe it a strong stock to consider in the overall portfolio. Wall Street and Seeking Alpha with another double buy. In fact, Wall Street even closer for this company than Alphabet at their strong buy rating of 4.5 and their very similar yield on offer of 0.43%. And over the last 10 years, very similar to Alphabet, this company has outperformed the S&P up 225%. In terms of their earnings, another green right across the board, not only outperforming over the last 4, but over the next 2 quarters, they see triple-digit growth to the EPS, and the subsequent 2, strong double-digit. Based on August 2025, this is a company with a forward P of 15.5, which when we do compare it to the overall sector, is trading at a significant discount of around 40%, but also significantly lower than their 5-year average by around 82%, something that is pretty much reinforced over the vast majority of different valuation metrics. For consistency, we will also compare it to the other valuation methods, and we can see, based over the last year, this is a company that is within the blue tunnel, although towards the upper end, so around the reasonable valuation, something that is also reconfirmed when we do look at it in this model. But what we also really want to highlight with Micron Technology is the A+ rating on their growth, 80% year on year, forward looking 42%, significantly higher than the sector on both accounts in the mid-single digit, but also significantly higher than their own 5-year of 2 and 8% respectively. Although bear in mind this company's industry is fairly cyclical, and over the next 5 years they're anticipating 38% to the EPS, whereas the sector in comparison sits at 15 and their own 5-year at 5.9, so it does look like still an incredible opportunity. In terms of profitability, they get an A+, gross margin 31%, a lot lower than the sector at 51, but actually higher than their own 5-year of 26. Bottom line 13%, a lot higher than the sector at 4, and also a lot higher than their own 5-year, so we are seeing efficiencies from Micron Technology, not only revenue increasing, but actually their margins are getting better over the longer term. and another company with a lot of cash from operations at 10 billion in comparison to the sector of 100 million, as well as their own 5-year of 9.1. As we said, each one of these today not only cheap but also the institutions are loading up. 81% ownership, 10 billion of sales over the last year, but we get around 50 to 60% more buys at 15.2, and we also notice, very similar to Alphabet, in the latest quarter, institutions were buying around twice as much as they were selling. Now, importantly, we want to run through our own valuation where we get to $124, and as you can see, based on the different growth rates, we have used 20%, although the low, medium, and high does give you the different values, and based on this 20%, we see this at $124. Whilst it may not look like a massive opportunity in comparison to when it was at its 52-week low, we definitely still believe this is one to consider. On the margin of safety, at 10%, a buy at 112, at 15 around 106, and at 20 not quite there at the $100 mark. So right now for Micron Technology, somewhere between 15 and 20% MOS. Wall Street very bullish, as we said, a near strong buy rating, $135 over the next year, translating to 30% upside. But as always, maybe you do like the company, but you want security and exposure to semiconductors right across the board, and therefore ETFs like SOXQ or like SMH may be one that you do prefer, but do give us your thoughts. Now, we also want to let you know we have just released our latest free weekly article. We drop one every single Monday morning, completely free to your inbox, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up. Also grab access to 45 undervalued stocks for the month of February. Lots of information, the upside that Wall Street themselves see over the next year, and you can also grab a recently released copy of 32 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, sign up, and you can read straight away. We then take you on to Adobe, which is down around 16% over the last year. Over the last 10 years, another massive outperformance of the S&P, up 481%, trading at the mid to lower end of the 52-week range. Another double buy from both Seeking Alpha as well as Wall Street. And when we do get to this company, we do love, of course, green right across the board. In fact, the next 4 quarters, so all of 2025, they are expecting double-digit growth to the earnings per share. And for November 2025, this company, based on their EPS estimate, does trade at a forward valuation of just under 23, which sits below the sector median, there in turn meaning you are getting a discount of 12% to the sector, but also significantly lower than their own 5-year average, and thereby 35% difference. In terms of different valuation metrics for Adobe, you may come to a very slightly different conclusion, but information is there. Again, different investors may have different criterias. In terms of the growth grade, they get a D+, which we don't think is fair given the information in front. Year-on-year revenue, 11%. Forward-looking, 10%, a lot better than the sector comparative at the mid-single digit, but it is a little bit underwhelming in comparison to their 5-year at 15 and 14% respectively. In terms of the earnings per share over the next 3 to 5 years, pretty much in line with the comparatives for the sector, 14.5% for Adobe, 15% for the sector, although a little bit lower than the 16% from their own historical averages. In terms of profitability, they do shine through with an A+. Gross margin, very impressive, 89%, a lot better than the sector at 51%. 5-year average, 88%, so a little bit better there as well. Bottom line, 26%, a lot better than the low single digit of the sector median, a little bit lower than their own 5-year of 30%. And the cash generated from operations, another strong one here of just over 8 billion, sector at 99 million, and their own comparative a little bit lower at 6.8 billion. If we take a look at institutional ownership, sitting at 82%, yes, 16 billion worth of sales in 2024, but we get another lot more buying here at 22 billion, and we can see, although marginal, institutions still, over the most recent quarter, were buying more Adobe shares than they were selling. In terms of our intrinsic value, we get to $577, which, as you can see, based on the low, medium, and high rates, we have gone for 10% today, which does in turn come to $577, indicating 27% upside. As always though, you can grab a copy of this model by clicking on the pinned comment below. In terms of margin of safety, as we do go along for Adobe today, you are getting nearer 25%, but at least 20% up to $462, Wall Street, as we saw, they believe this to be a buy. They anticipate $580 1 year from now, translating to 27% upside. This then takes on to Lockheed Martin, one that is up only 2% over the last year. Over the last 10 years, up around 113%, pretty much trading right there near its 52-week low. Another double buy from both Seeking Alpha as well as Wall Street, and this company does pay a dividend, unlike Adobe, sitting at just over 3%. And if we look at their earnings, whilst green over the last 4 quarters, signaling good historical track record, over the next 4 quarters, they are expecting 3 of them to be a decrease, and based on the EPS for December 2025, it does trade at a forward valuation of just under 16. Having said that though, that is well below the sector median, giving a 22% discount, and it is only a little bit lower, about 3% than their own 5-year average, but overall valuation, they do get a C+. If we take a look at their valuation, we do get a reasonable signal here, sitting in the midpoint of the blue tunnel, and then when we take a look and we can incorporate dividend yield theory, which tells us a company is undervalued when the current yield sits above the 5-year average, we get an undervaluation signal here, a reasonable one here, as we already mentioned, not far off their own historical average. And when we take a look at the growth of this company, it does leave a little bit to be desired for, unlike the previous 3. Revenue year on year, 5%, forward looking around that as well, a little bit higher than the sector median on both accounts, and pretty much around their own historical averages. In terms of the EPS over the next 3 to 5 years, sitting at 6.5%, quite a way below the sector at 11.5%, but only slightly higher than their 5-year of 5.82%. Profitability, they get an A+, gross margin quite low at 10%, sector at 32%. As we can see, their own 5-year average does sit a little bit higher at 13%. Bottom line, 7.5%, better than the sector, although marginally at 6.4%, worse than their own 5-year of 9.7%, and their cash generated from operations, whilst very strong at $7 billion and above the sector of $346 million, is a little bit lower than their own historical figures of $8.12 billion. What are the institutions doing with their 74% ownership? Well, $6.5 billion worth of sales, but quite a significant amount, nearly double the amount of buys in 2024, and we can see nearly double the amount of buys in the most recent quarter. In fact, that is a trend that has continued all through the quarters in 2024. Institutions very, very bullish on Lockheed Martin. Now, our intrinsic value today coming at $552, the average of these 3 models. We can show you the first one, multiples valuation, companies in a similar sector and size, average PE multiplied by the EPS of LMT, giving us our first undervaluation signal. Bear in mind though, we're not looking at any of these models in isolation. DDM model, the average growth of 6.6%. We've gone lower to be on the more conservative side at 5.5, another undervaluation signal. Then based on the discounted cash flow model with growth of 7%, we get a third and final undervaluation, and then we get to that average of 552, which does give us a nice margin of safety as we do keep going today. Not at the 25% level just yet, but you're getting at least 20% up to $442. Wall Street themselves, price target $540. They see 24% over the next year. As we saw at the beginning of the episode, that is above what JP Morgan see for the market at 9%. As always though, do give us your thoughts in the comments below whether you're buying any of these 4 stocks. Maybe you're holding them, or for whatever reason they don't fit your overall portfolio and you are looking to sell. Don't forget as well to sign up to the free weekly newsletter, grab those spreadsheets, come and join us on Patreon where we do cover our weekly buys and sells. We have been buying and selling over the last few weeks given the volatility in the market, and as always, have a great day. We'll see you all on the next one.